Welcome to the inaugural series of The Impact Bite, the podcast which showcases the various perspectives of different investor categories in relation to the current investment landscape. My name is Will Lowry, and I co-lead the Institutional Investor Network at ClearlySo, Europe's leading impact investment bank. I will be your host for this week's daily series, in which I look to test investors' genuine appetite for impact investments, as well as challenging 5 highly relevant yet different investor profiles in order to gauge whether the investor lens really does vary across family office, impact funds, private equity, venture capital trusts, and corporate venture capital amidst the post-COVID-19 investment environment. Welcome to the 4th episode of this week's Impact Bite series. There has been an incredible amount of interest in today's episode, which I believe is largely reflective of the increasingly important role that family offices play within the private markets. It helps, of course, to be joined by such a high-profile name in the family office space, Eva Tarasova. Eva is an investment director at Wharton Asset Management, joining the team back in September 2014 to lead on cross-sector origination, deal analysis, and the execution of investment opportunities. In this capacity, Eva has developed an extensive network of family office and co-investment partners, leaving her ideally placed to share valuable insights on the coveted family office mindset. I first met Eva back in early 2019, and while she often challenges the entire ClearlySo team with her rigorous approach to due diligence, I must admit that I am more nervous about today's interview than any live mandate discussion, having only just discovered that you attended the London School of Journalism and started your career as a highly successful reporter. Is that true, Eva?
That is true, but to be honest, journalism was always my passion. My first article was published when I was 12 years old, and that was a really big success and breakthrough for me. Since then, I've been always writing something and always, having little interviews with people, and it's just a really big passion. But unfortunately, journalism, as it is today, everybody can be a journalist because we have the whole kind of abundance of bloggers today and Instagrammers and everybody else. So quite early on in my career, I decided that maybe I should actually go somewhere else where my talents can also be used, and that was investment world. So that's why the last 10 years before Wharton, I worked for a multi-family office as well. So I've spent just working in the investment space.
Well, the family office space is lucky to have you. Eva, the aim of the Impact Bite episode is for you to share your insights as a family office investor as you adapt to the current investment landscape. So on that note, could I ask you to begin by sharing your key takeaway or learning about the private equity or venture market during this period of lockdown?
Well, I have noticed that in the current landscape, both VCs, PEs, family offices, whoever that might be in that landscape, everybody has this view that this is the best time to focus on your own portfolio. I do hear about deals being closed, new things being invested in, but realistically from everybody I've spoken in the industry, everybody is really focusing on really ramping up their portfolio and making sure that, first of all, there is runway extension. Second of all, there is a really significant cost cutting being implemented. And the whole strategic advice became absolutely crucial in these times of adversity. So my key takeaways from the times that we're living through right now is that what's really important is transparent communication. It's about being really honest to all the stakeholders. May it be your investors, the contractors you work with as a startup or scale up, may it be your employees, because realistically loads of startups we're seeing right now having all the layoffs, adopting to the completely new environment. This is the time when we really should be focusing on managing expectations and doing it in the most clear way possible. So I'd say the takeaway is spot the opportunity, really track hard your expenses, and really implement the transparent communication as much as possible.
That's really interesting, Eva. And I guess focusing on your portfolio in particular, given the range of investment types and stage, have there been any stages which have been particularly affected? So have you seen more of an impact on the seed growth as opposed to the mature PE, or have you been surprised by what you're seeing in terms of that development?
So in our portfolio, which is really diversified, we invest in everything ranging, from biotech and life sciences down to consumer goods. We've noticed more, it's not about the stages of the company development, it's more about the sectors. Being a really heavy biotech investor, I can tell you that's one of the sectors which has been hit the hardest. And the reason for that is because at the moment, every single biotech startup is rushing into the space of COVID-related, either vaccine or treatment. And what has happened is that majority of the clinical stage startups in that space, their clinical trials have been put on hold because simply, just to kind of a bit of background for the biotech space is that when you're doing a clinical trial, you really need to do your clinical trials throughout multiple hospitals and multiple countries. And what has happened is majority of the hospitals actually are now closed down and cannot be recruiting the patients for the trial. So, which implies that companies in this space now basically are essentially no but name a furlough because they're sitting at home, not really doing much, even though, officially they're still kind of working, but they can't really do much without actual physical research. May it be either in the lab space or in the actual hospital. So what happens in this case is that this sector for us as investors has been hit badly because not only you need to think about what you actually do with these people throughout these times when they can't really do their jobs properly, but it's also about the runway extension. Because at the same time, yes, you have a bit of a cost cutting during those times because, trials are not really taking place, but at the same time, you're still paying, your office rent, your salaries, all the social welfare. I'd say biotech was one of the sectors which been hit the hardest from our perspective. And another one thing which has really kind of not coping so well during these times is PropTech. Mm-hmm. Because in PropTech, lots of things which kind of are involved into people moving houses or buying, selling new property or mortgaging, remortgaging. Right now, not many people actually, not that they don't want to move a house, they actually just physically can't do so. So I'd say there are certain sectors which have been hit the hardest. And amongst those would be probably travel, lending, because now at those times we finally can understand which lending companies have been doing their jobs properly and have been lending to, really reliable customers, or those who have kind of really closed their eyes on the due diligence. Another sector which I think has also suffered tremendously is insurtech, because right now the amount of payouts is increasing, and realistically, a lot of people just can't afford to do so. So yeah, it's definitely about the actual sectors rather than the stages of the businesses.
Okay, and those sectors have obviously been hit very hard in terms of valuation. So when you're looking at biotech investments at the minute, and I know that Wharton reviews a lot of opportunities, are you finding that you're having to reflect different terms or structures to offer supportive valuations in order to keep founders and entrepreneurs engaged?
So we've been always very fair on valuations, because what we don't want to end up with investors is that founders raise from you at this time, then there comes another 5 rounds, and what happens by the end of this fundraising, they literally have no equity left. So that's why we always have really paid attention, being on the founder side rather than investor side in this case, trying to kind of find an optimal balance. What sort of chunk of the company we would like to have for our investment, but what also makes sense for the founder. So in terms of here, for example, in terms of valuations, in our current companies, we have just completed throughout the last 3 months 4 top-ups. They were all done through a convertible rather than a normal sort of equity price round, which for us is also very unusual because we just prefer the straightforward, plain vanilla equity investments rather than convertibles. But because obviously you can't really value those companies in today's world, because either, the market is still there, but the traction might not be so great because simply people are not buying, people are not, using the services. Sometimes it's also, things have slowed down. So biotech is a prime example. How do you today value a biotech company when, they have stopped doing their trials? So, the things that they've promised you to deliver in, say, 6 months or 12 months time are no longer feasible. So 2 kind of things happening. It's either as an investor, you do more convertibles when it comes to your existing portfolio companies, or what we've been having seen a lot, because obviously not everybody could survive the crisis. So this week we have closed an investment in the biotech company, which unfortunately went into administration in the beginning of COVID. So we had a great opportunity to literally buy out a great asset. And now we're rolling it into one of our existing portfolio companies at literally very little cost. So it makes a great time to actually go shopping right now.
That's super interesting. And it leads me on to my next question, because I've asked all of our panelists about whether the investor-founder dynamic has changed as a result of the pandemic. And obviously, I can see that you have been very flexible in your investment approach, whether that be with convertibles, as you said, or buying ultimately what was a distressed asset in order to embed that within another portfolio company. So how do you think the whole of COVID-19 will impact your investment process going forward?
Well, I'd say we always have been quite cautious and quite opportunistic. So for us, since we're quite a cross-sector and cross-stage as well, we're always looking for opportunities. But I'd say there is much more caution, and which is reflected in, first of all, the appetite has really changed from our perspective. If before we were quite likely to write big checks into companies for the initial investment, that was absolutely fine with us. What's happening right now, we're kind of taking a view, let us try out with a much smaller check, see how it can really sustain itself throughout these times of uncertainty. And then, when there's a next round, next opportunity, we can always top up. So I think the kind of concept of black swan events has suddenly become much more apparent, and there are much more unforeseens that we thought wouldn't be actually possible, but they are today possible. So I'd say there's more hesitation, and there is probably much less convictions on bigger rounds and bigger investments. But the reason why it is so for us, it's not because we're cash restrained. It's more about the fact that we have quite a few companies in the portfolio already. And in terms of money deployed, majority of it, as I said previously, is in biotech and life sciences, which basically means that we have to extend runways in pretty much like 70% of our portfolio right now.
Understood. And as you know, Eva, ClearlySo advises a host of these high growth and high impact enterprises on their capital raising process on a daily basis, really. I must say that I've witnessed a real shift in founder preferences since the outbreak of COVID-19, with entrepreneurs increasingly prioritizing and in some cases even limiting their target investor audience to family offices such as yourself over other categories of mainstream institutional investor. Is this a trend that you have experienced since the first quarter of this year? And as a follow-up to that, what attributes or characteristics does a family office bring that makes it so appealing to early stage businesses?
I would say family office has been a growing space for quite some time now, and I understand the attractiveness of family office investor as opposed to, say, VC investor. Even though I don't necessarily always agree with that, I think as a founder, what ideally you would like is best investor for your exact venture. The advice we give to all founders is essentially build up syndicates. Have, one family office, one VC, maybe a couple of really good, strong angels in the area that your startup is in. But I understand the reason why startups like family offices is because, first of all, we don't really have a time horizon per se. We're really happy to be invested for as long as need be. Obviously, at some point, we would like to see the money back or maybe see dividends being paid out or whatever that might be. But there is no kind of strict thing that, I'm only in and out realistically for like 3-5 years and then I have to sell out from the venture. And also, I think the biggest appeal of family office as opposed to VC managers is that when you have a family office invest in you as a startup, you really are getting the expertise of somebody who has really been through on this journey. Maybe that has been in a different sector, in a different geography, but they've really, the people who have family offices, it means that they've accumulated enough wealth over years, so maybe they've inherited it, that's a different question. But the difference it makes is that they've been on this journey. They know exactly how hard it is to, make things work. And this, I think, is a very valuable asset that family offices are bringing with them, is like this expertise and knowledge that things are possible. You can be the next big name in the industry. And what was the first question?
And the first one was asking whether you've seen a trend of founders looking to access private family office capital over traditional mainstream VCs.
There has been a lot of this recently. I say last sort of 6-12 months have been really active time for this family office space, because I think traditional VCs at the moment have too much strict of criteria, in a sense that, for example, as a startup, you have to really do the box ticking. You need to have a minimum amount of ARR. You need to be on a certain growth trajectory. Whereas like as a family office space, because you're playing with private money, that's what it is, and no bad name. It's a play. You can be a bit more flexible by, okay, that ticks this and this in the box. This box, it's not there yet exactly, but we can see how we can get there. And obviously, because of the time horizon being less of a pressure, that becomes, I think family offices as a class become one of the favorable investors for startups and scale-ups.
I'm going to ask you for a bit of advice for the wider investor network that are listening in. Which 2 resources, tools or tips would you recommend to other investors as a result of your experience as a lockdown investor?
I mean, to be honest, my experience as a lockdown investor has been really a weird one. I've spent most of my lockdown time actually learning how to bake, because my idea was which of the founders would say no to a really good, nice, freshly made sourdough, right? But jokes apart, apart from I think that's been a really great time to actually learn new things. So obviously my background is not in the medical space, but being an investor in the sort of biotech and life sciences, I thought that this time is ideal for you as an investor to brush up on your knowledge, sort of learn a few new things. So for example, I have just done an online course in neuroscience to actually understand the basics, how our brain functions and how that can, be valid for anything new coming up in the areas of neurostimulation, dementia, Parkinson's, and all that sort of related diseases. So the two top tips is basically learn something new, really take the advantage of the temporarily unloved sectors, because everybody is rushing in something new and trendy, but really take time, because now you have time as an investor. Study something which before you would have thought is, it's kind of on the back burner. Maybe one day when I have time, I do it. So this is right now is the time. And the second thing I think is really clear your karma debts. So we've all been guilty for not replying to those thousands of emails we've been accumulating throughout years and years. May it be from fellow investors, maybe it be from some other startups. I think it's really a great time when you actually have time to answer all those emails, and at the same time, not only kind of pay off your debts, but also broaden your network and hopefully come out as a much better networked person out of this lockdown.
Well, Eva, you sound like you've been busy. And not only have you been clearing your inbox, you've also been sending founders sourdoughs. So you're putting us all to shame at the minute.
I actually sent a couple of founders, a couple of cakes. Not
Incredible.
The bread, but cakes, yeah.
Incredible. I'll check my post box again to make sure that I haven't missed mine. Eva, if you could invest in any deal tomorrow, what would it be?
Well, I mean, technically, we did invest in the deal on Monday, so that could have counted as our tomorrow, right? It was only a couple of days ago. It's a really interesting question what I would invest tomorrow if I had two options. Either in something which would go along the lines of sex, drugs, and rock and roll, but in a more legal way. So, so by sex, I mean something which basically kind of increases your happiness and well-being. So that might be a startup in, say, well-being space and health, or maybe in reproductive health, because realistically, people are sitting home, they have not much else to do. So I'd say companies which are right now in sex industry and sex toys, for example, or in fertility tracking are really gaining momentum. Drugs, again, only legal way possible. So things which really get you addicted, might it be, direct to consumer, or maybe new entertainment platforms, because people have so much time at hand, so they're really willing to get addicted to something new, but something good. Nothing, illegal here. And rock and roll is basically anything that kind of gives you happiness. So I'd say if I could invest in something on Monday, that'd be something which actually, gets you really addicted, can go viral, and makes you just a really satisfied, happy human being. So, but that, I don't think that necessarily goes well with our strategy of investing in biotech and life sciences at the moment, but I'm allowed to have a bit of diversion from our general investment strategy.
That's definitely the most interesting answer I've had all week, Eva, on that question. And I doubt I'll get a better one. To be honest with you, I think you've definitely woken up a number of our listeners with that response. Sticking on the theme of sex, drugs, and rock and roll, if that deal was in front of you next week, how would you rank the following areas of criteria or corporate profile when analysing a deal? So management team, target market size, impact, near-term profitability, and high growth.
Well, for us, always management teams, the founders have been the key, because you invest in people, and I can't emphasize and stress enough, because every single investor I meet says, yeah, we invest in founders, right? But everybody is willing to invest in founders, maybe who have some experience in the space, or second-time founders now, that since we've got, some really great exits in the industry. But I think people really make things happen. If you have a great founder with a so-so idea, they can still make it really big and successful. If it's a great idea, but the founder team is not strong enough, it's just a no-go. So I'd say the most important bit is management team and the actual founders, followed by impact. I'm a big believer that anything you do in life, anything you invest in, has to create impact, but impact in the broader sense of life. That might be with, a social networking platform, because maybe you're connecting people from various parts of the world. That might be also with a, new drug discovery, which saves lives. So impact is something, almost every single investment, apart from obviously, the naughty ones, which are not making our life better, but actually making life worse, are creating some sort of impact. So I'd say management followed by impact. And the next one would be probably market size. I'm not necessarily talking about the market size. It has to be massive, because I also think that market size can be quite small, but you can create a really big impact on it. A prime example of this is rare diseases. Very small numbers of people affected, but if you really hit a blockbuster drug, that's really a big success, not only for you as an investor in terms of financial return, but actually for changing lives of people who after the day had no other solution, essentially. And then I'd say it's high growth. So I believe that high growth is super important, because it's not necessarily about that you kind of like growing, very quickly from like 0 to 1,000 within 1 month. It's more about it's consistent high growth. So you're having like an incremental steps of 100 each month rather than just kind of flying. And I rank the near-term profitability as the last, and the reason being that, so one of the chairmen of one of our portfolio companies, he always has this really wonderful expression about profitability. And I'm not sure I'm allowed to use that sort of words, online in the podcast, but I'll share it with you. He always says, we should not all just rush to the clitoris, by which he basically means that near-term profitability sounds very exciting. It means that your business actually is a business rather than just some venture. But what's really important is you don't want just to kind of have the one bum, thank you, mom approach. You want something which is long-term, sustainable, impactful, has stamina and resilience to survive. So I think things with the near-term profitability are great, but only if they can justify that this near-term profitability is actually sustainable over the course of time.
Well, I couldn't have put that better myself, even if I tried. And also, really, really interested to hear the impact angle there as well. It's certainly a theme that we've heard this week from all investors that have sat in the hot seat, and it's something that we, as you know, hold very dear, because we believe it is something that's becoming more and more mainstream in terms of investment strategy going forward. On to the quick fire rounds. Eva, I've got to say I am looking forward to this one, given the insights you've shared so far.
No pressure, right? Yeah.
No pressure at all. You can't see me blushing, fortunately, because it is a podcast, but I will be saying 3 statements to which I'll ask you to provide an immediate, and I've got no doubt that it will be genuine, response. So the first one, private market prospects for the second half of 2020.
Private market, honestly, if I was starting my investment career today, I would not touch private market. The reason being, you really have no idea what's gonna fly anymore. B2B space, right? Not much growth, but at the same time, not really much churn. B2C space or D2C space, all over the place, right? You have no idea anymore what sort of things gonna sell and what people are really gonna look. And even though from like a quite fair amount of fellow investors, I've heard, yeah, but you should be investing in the future of work and the whole kind of mobility sector, all these wonderful things. I appreciate that. But realistically, my advice is maybe stay away for a bit from, investing into the new things and the private market in general, and just kind of maintain a little bit of dry powder to spend once things kind of clear out.
Good answer. The second question is impact investing, a mandatory strategy or personal preference?
Of course, a mandatory strategy, right? And I think people have to realize that impact is not just a fancy word. Impact is anything you do in life. By helping people having better lives, better access to whatever that might be. Ranging from food, education, health. Even if you're impacting, as we previously have touched upon this, the market side. Even if you're impacting a smaller population, it still is super important. You can't just be selfishly investing for the sake of making profits. The key here is really to make money, because to do good, you need to have cash. Otherwise, you can't help others. But at the same time, you can't just, go and invest in things which are making you return, but at the same time are not really doing anything to the world.
Thanks, Eva. And the final question, I'm a bit worried that we might have to censor this one, but what has been your most surprising lockdown hobby?
To be honest, I have a really boring life, right? So baking, as I told you, right? And I've tried to bake. I've been baking almost every single day. I've tried like everything from literally like sourdoughs down to like donuts and like any types of cakes. I've been painting a lot as well, because that's, something which relaxes me. But it's nothing really which you should be censoring, to be honest. I've been really quiet at home. And what really surprised me in all this is that as a part of my job, I'm super sociable. And I'm always out and about meeting new people, talking about new deals and closing new deals. But this lockdown has actually taught me that I'm fine just on my own, sitting and working from home. I don't really need all this hustle and bustle. So I think that's the most kind of surprising moment of my lockdown life.
What an entertaining podcast. I really can't thank you enough. I thoroughly enjoyed that. And I know that the audience will have a number of insights to focus on. The amount of takeaways that I've written down on my pad are too many to run through now. But, the flexibility of family offices, the insights that you've given on the biotech sector, I think critically the advice that you've offered to founders, specifically around thinking around the right investor and the idea of building a syndicate in order to leverage the different skills that investors can bring is a really powerful one, as well as the advice that you've offered up to fellow investors in the sense of start focusing or start learning about the temporarily unloved sectors. I think that's a really compelling point. We've only been hearing about digital health. We've only been hearing about, the sectors that are hot at the minute. So why not focus on those which are maybe a bit quieter, because those will be the ones where the opportunity definitely lies. And lastly, I think you've definitely caught the attention of any founder operating in the sex, drugs and rock and roll space, who can no doubt expect a sourdough or a donut this time next week on their doorstep. But look, Eva, thank you so much. That was really fascinating.
Thank you for having me.
It was our pleasure. And we will be back online at the same time tomorrow. So 12:30 on Friday, the 19th of June, for the last episode of our inaugural Impact Bite series. We have, of course, made sure to finish with a bang, as I'll be joined by 4 Impact VCs, co-founder and managing partner, Pauline Wink, who, believe me, certainly won't hold back when it comes to sharing her views on what it really means to be investing in the current climate from an impact investor's perspective. If you haven't done so already, I strongly recommend that you register online now. Likewise, please do feel free to contact me directly with any questions or requests on william.lowry@clearlyso.com. I hope you've enjoyed today's show, and why not end the week on a really positive note by joining Pauline and I at the same time tomorrow. See you then.